I think we'll make a start. There are a couple of people still joining, but joining numbers seem to be dropping off, so that's good. Welcome to our latest On Top of Tax webinar. This is the second of a new series of webinars that we're running to help you stay on top of all things tax. They're going to keep you up to date with changes impacting UK business, including topical corporate tax news, international tax news, VAT and employment tax updates, case law guidance, and other significant developments as well. So we've got about an hour together today, including some time for questions at the end. So I am joined today by some colleagues who will be talking alongside me. We've got John Chaplin, who is a partner in our employment taxes team, Saeed Riza, who is one of our indirect tax specialists, and Jack Sloggett from our tax dispute resolution team. So between us, we'll be giving you an update on some hot topics. Next slide, please. So the agenda today, there's going to be a corporate and personal tax update, which I'll be giving you, including a bit of a budget recap. Then Jack is going to talk about some case law developments on R&D. John will be covering some employment tax updates, and Saeed some VAT and other indirect tax developments. There will then be time for Q&A, so please do put your questions into the chat and we will get to them at that point of the agenda. And then there'll just be a quick piece at the end where I'll run through some other events that we're running that might be of interest to you. Next slide, please. So starting with corporate tax, some key dates that you will want to be aware of that are coming up. 31st of March, realise that's only 11 days away, so things are getting tight, but there is still time to take some actions if you need to. So particularly it's the deadline for 2-year claims and elections for corporate tax periods that ended on 31st of March 22. For example, R&D tax credit claims. So make sure that you've thought about everything that you need to do for those March 22 year-end periods if you have one. It's also the SAO deadline for June year-end companies. So for your June 23 period, you need to make your SAO filings by 31st of March if you're within those rules. That's UK turnover 200 million and 2 billion asset sheet balance sheet asset value. So you'll no doubt know if you're in those rules, but you do need to make sure you make your filings. PLCs have a shorter time frame as well, so it's for September year end for PLCs. Also 31st of March is the last date for amending ATED returns. That is for companies and similar sort of non-natural persons that own UK residential property that's worth more than £500,000. So if you need to amend your March 23 return, you've got until March 24. So if, say, you sold the property in the year. You've also got to file your returns for the next year and pay your tax from 1st of April. So you've got April to do that. Also from 1st of April, the merged R&D tax credit scheme starts in earnest. This applies for accounting periods starting on or after 1st of April 2024. There's going to be a new main rate of 20% credit under the new merged scheme. SMEs that are R&D intensive loss-making companies have a separate scheme, and the intensity threshold that you need to meet will be reduced to 30% from 40% from 1st of April as well. I'm not going to go into any detail on that because I'm sure those of you in the scheme know the details well by now, and there's plenty of guidance available, but just to flag that point. There's also a point that isn't on here just around notifying if you're claiming R&D credits for the first time, or the last claim was more than 3 years ago. Companies with accounting periods starting on or after 1st of April 23 now have to notify that you're going to make an R&D claim within 6 months of your year end. So if, say, you have a March 24 year end and it's the first year you're going to make a claim, you've got a few more months to do that, but you could just notify the revenue now and make sure that that's one thing off the list. Some corporate tax payment deadlines for companies, 1st of April, and those in quarterly instalments, 14th of April, that you'll see on there. Also need to make sure that you've remitted your withholding tax for any withholding that you've made in the quarter to 31st of March, and filed your CT61 return by the 14th of April. Lastly on here, 30th of April is flagged for SAO deadlines for those with October or July year ends, depending on whether you're a PLC or not. Next slide, please. So a bit of a budget roundup. I'm not going to go into a lot of detail, as I'm sure you may well have read a lot of things on this, but just as a recap, there's going to be a working group formed to consider the extension of full expensing to leasing assets. That's only going to be when affordable. So we don't actually know the start date, but we're expecting some draft legislation to be published shortly. So that's a positive direction of travel, but start date unclear. There was some creative sector release extended. So there's going to be, say, a new independent film tax credit for certain types of films starting from April 24, for example. There wasn't very much on R&D in the budget, but there was a comment that there's going to be an expert advisory panel established to advise HMRC to support the administration of R&D credit reliefs. So that's going to help HMRC understand what's truly qualifying R&D and support them in administering those claims. A couple of other points around economic crime levy increases and energy profit levy being extended by a year. If you're in those rules, you'll know about that already. There is a change around SDLT, multiple dwellings relief, as well, just to flag. For purchases with an effective date on or after 1st of June 24, that relief will be abolished, not by specialist subject by any means, but I think it means that you effectively no longer pay SDLT on average value of multiple dwellings purchased. It's kind of on the aggregate. Personal tax wise, non-dom status, I'm going to cover in a little bit more detail shortly. There's going to be a 2% cut for national insurance for employees and also for the self-employed. Worth noting that there's no reduction for employers on their NIC rate. There's going to be some changes to the high income child benefit charge, which I know has been sort of closely watched and covered in the press. The threshold before there's any clawback of child benefit will be increased to 60,000, and there's also going to be a longer period at which that's actually kind of clawback as well. So some relaxation there. Furnished holiday lettings regime will be abolished from April 25. That regime treats certain short-term residential lettings as a trade for some tax purposes. But going forward from April 25, it's going to be treated as a property investment business, and that has certain tax consequences that I won't go into. Capital gains tax on residential property, currently 28%, will be cut to 24%. For exchanges on or after 6th of April 24, and then just a couple of bits at the end there about other changes. For example, there's going to be a consultation on whether to launch a British shares only ISA, giving you an extra 5,000 allowance. Next slide, please. So personal tax key dates, 31st of March, again, practical deadline for taking advantage of EIS and other similar reliefs. Worth reminding you there that there were some increases in the limits around some of those schemes during the 23-4 period. So make sure that you've kind of thought about that and made the investments that you want to make. 5th of April is the end of the tax year. I'm sure I don't need to tell you that. So make sure you've made all your payments into your pensions and ISAs, etc. It's also worth thinking about whether you want to use your capital gains tax exemption, which for this year is £6,000, but is going to be reducing in future. So the 6th of April, new tax year, and some of the things that I covered from the budget will come into effect. And it's worth noting the summer 24 point on that slide is focused on whether you might want to think about the furnished holiday lettings changes, for example, and actually take some action before those rules come in 2025. Next slide, please. So just on the changes to non-dom status, as you'll be well aware, the government announced at the budget that the remittance basis of taxation for UK resident non-doms will be abolished from April 25. There's going to be a new foreign income and gains regime, which is going to be effectively a 4-year regime rather than effectively the 15-year one that there is now. There's going to be some transitional reliefs. For example, a temporary repatriation facility that might actually encourage non-doms to bring income to the UK. It would give a 12% tax on remittance of personal pre-6th of April 25 foreign income and gains during the 25/6 and 26/7 tax years. There's also the possibility of only 50% of foreign income arising in the first full year, so the 25/26 tax year, being subject to UK tax as well. So there'll be various transitional reliefs that those affected no doubt will be thinking about and considering over the coming weeks and months. There's also going to be a change to IHT as well. There's a consultation to be launched to provide more details, but the intention is to move to a more residence-based system again from 6th of April 2025. So on that note, I am going to hand over to Jack, who is going to give you some case law updates.
Thank you, Carol. Good morning, everyone. My name is Jack Sloggett. I'm a senior manager here at BDO in the tax dispute resolution team. So we deal with disputes with HMRC in the past. And currently we're seeing, as I'm sure a lot of you are, a lot of movement in the R&D space. So I thought I'd give you a brief update on cases and also a general overview of the developments involving R&D. So in the past few years, biggest R&D case, that's R&D expenses have been subsidised. This is important for SMEs as it affected the availability of SME relief. Now, in the tribunal, they found that without a clear link between the price paid by the client and the R&D expenditure, then it can't be said that it was subsidised. So this prevented a narrowing of the scope for SME relief, so which seems like a great win for the taxpayer. However, HMRC haven't relied on the decision. What they've said is, well, actually the facts are too specific for Quinn, and they've continued to try and apply that, try and narrow SME relief by saying some of the expenditure is subsidised. Now, we understand that in the last quarter of last year, 2 cases were heard at the FTT on subsidised R&D, and also a separate case on whether R&D activities were contracted out. So both of these cases affect whether SME relief is due. And again, it's another attempt by HMRC to effectively narrow the relief. So it's them trying to sort of put the rights of Quinn to rest. So on the basis that these 2 cases were heard in the last quarter of last year, we hope to hear a decision on both of these cases hopefully soon. So I think hopefully in the next few months, we'll get a bit more clarity on where HMRC are going on claiming SME relief for SMEs. So on the screen there, I've also highlighted H&H contract scaffolding. This is an R&D case, but it's not about whether R&D was due. It's about the taxpayer went to tribunal to try and defend that his behaviour, he took reasonable care when undertaking his claim for R&D. So in the case, the taxpayer was successful in an appeal against an attempt to impose careless penalties. The taxpayer received advice, an R&D advice, and their view was that just because their advice was tenable, and just because HMRC took an opposing view didn't mean that accepting the advice was careless. Now, for careless errors, generally, it's down to HMRC to demonstrate that a careless inaccuracy has occurred. And the tribunal said that HMRC didn't do this, and actually that a statement of reasons they submitted was confused. So it was quite a sort of climb down from HMRC. And so although the taxpayer won this, the reason I've highlighted today is that penalties in R&D inquiries shouldn't be forgotten. They should always be considered, and HMRC will always include them on any inquiry notice they send out on R&D. And this is especially the case because of the increased inquiries that we are seeing in the R&D sector. Can we have the next slide, please? So it's no secret that HMRC have increased the amount of inquiries into R&D claims. They receive thousands and thousands of claims each year. And back in 2021, HMRC estimated that 4.9% of these claims involve fraud or errors. So the figure up there is that accounted for £469 million. It's a huge number. So it's understandable that they've increased the inquiry presence in this area. And the problem is there's been grumblings among taxpayers, amongst advisors, in how HMRC are going about doing these inquiries. And the way they're doing it is what we put on number 6 there, what we refer to as a desk-based approach. And what I mean by this is HMRC are sending out large information requests to each claims to try and understand the detail in the claim. Now, when faced with this, when asked for information after information to the taxpayer, to the advisor, sometimes you're like, I don't understand the relevance of this. It seems like there's no rhyme or reason. But if you look at it from HMRC's point of view, it's understandable. R&D is very complicated. I mean, the whole purpose of the scheme is to recognise scientific or technological innovation. So, of course, this desk-based approach is going to lead to protracted correspondence as HMRC are trying to understand extremely difficult and technical points, which to the people working on them is probably quite simple because they're working on them day in, day out. Can we have the next slide, please? So with the inquiries, we can group these into effectively 2 categories. Is it relevant R&D? And then there's computational and process matters. So with the is it relevant R&D, this is where the technical specialists are required, and this is where HMRC have probably the biggest hurdle to get over to understand what's gone on. So to answer this, the taxpayer really needs the support of a technical specialist, a scientific specialist. They need to understand the science. They need to understand the marketplace to determine, well, actually, has there been a jump in innovation? And also they're going to need someone who understands how HMRC are operating, especially as they're operating using this desk-based approach and this letter after letter. It's about cutting through to what the actual issue is. And then on the other hand, you've got this computational and process matters. So it's where there may be an error or someone claiming under the wrong scheme or a foreign business has misunderstood the rules. Now, prima facie, this may seem a bit simpler to deal with, but actually, this is a very fast-moving area. I mean, as Carol mentioned a minute ago, the merge scheme is being introduced in April 2024. Back in August 2023, the additional information requirements were introduced. And so actually what before it was just filling in the form has evolved, and people are going to trip up and make mistakes. And so it's always obviously beneficial to check it. And this is where HMRC are having difficulty because they're dealing with the grumbling of the taxpayer, but they need to ensure that everything's done correctly. Can we please go to the next slide? So this desk-based approach that HMRC are doing, it's how do we challenge HMRC's view? Obviously, once correspondence has ended, once you provide the information that HMRC have required, and you reach an impasse, what do you do? So HMRC have said, well, this is our view. There's 3 options for you. And also these are numbered wrong, but the first thing to do is you can ask for statutory review. You can ask for the case to be reviewed by someone independent of the inquiry team. You can go to something called alternative dispute resolution, i.e. mediation. This is where you effectively get HMRC into one room and you have a day of discussing the points, going through the arguments and really explaining to them face to face what the issue is, why there's been an innovation, or technological innovation. And the third one is the most extreme, is you can make an appeal to the first tier tribunal. This is, I guess, a last gasp approach. It's very costly, and so also we always recommend stat review or alternative dispute resolution in the first instance before considering tribunal, especially ADR, as we call it, as we found it very beneficial in dealing with R&D inquiries. Thank you. I think that's the end of mine, so I'll pass on to the next presenter. Thank you very much, guys.
Thanks, Jack. Good morning, everybody. My name's John Chaplin. I'm going to be having a look at some of the employment tax elements for the next few minutes. Before we get into the detailed topic that I just want to cover, a bit of a reminder on a few of the things that are coming up on the near horizon from an employment tax related matter. The first one I hope you're all aware of is that from the 1st of next month, we've got the increases in national minimum wage, national living wage coming along. So hopefully you've got all of those into your HR and payroll systems by now. But the reason for banging the drum on that one is that it is quite a current topic for HMRC in terms of checking that organisations are paying in accordance with national minimum wage levels. And I think the issue this time around, perhaps more than any other time, is that the increase in rates, particularly for some of the younger individuals around apprentices and early 20s, etc., have been quite significant. The maximum increase this time around is just over 21%, which is quite noticeable, particularly if that's where the majority of your workforce are based. So just be aware of that one, but I'm not going to go through in lots of detail on each of these points. The other one I want to pick out on probably is the registering to payroll benefits in kind for the next tax year. It's not mandatory. You do not have to yet payroll your benefits in kind. You can still do P11Ds and do them, for want of a better phrase, the old-fashioned way, at least in HMRC's mind. But if you choose to put them through payroll now, you have to let HMRC know, simply so that they don't end up taxing the workers twice, once when the benefits are reported at the end of the year, and obviously once through PAYE during the year. As you probably are aware, payrolling of benefits will become mandatory. The HMRC are still considering when that's going to be and are consulting on that. The current thinking is that it will be a couple of years yet before it becomes mandatory, but even then the P11Ds will probably exist running in line with that for a few years after that as it beds down. But you do need to perhaps start looking at how you might apply PAYE and NIC at source as appropriate to benefits on a payroll by payroll period, so that you're not leaving it to the last minute when it becomes a you must do rather than you might like to at least start looking at it. And then last but not least, the employees intermediaries quarterly report. And just a quick overview of this. This is something whereby typically an employment agency or an intermediary who is paying the worker but might not be using the services of that worker. So in other words, they are providing that worker to a third party, have to make a return on a quarterly basis to HMRC of all workers where those individuals are not already going through pay-as-you-earn and NIC deduction in full. Now, most of you, if you're already having agency workers and they're going through pay-as-you-earn and NIC, won't be an issue for you. But if any of you have self-employed workers engaged by a third party, an agency, for example, then you'll need to be aware that they will be doing those returns, and as such will maybe need more information from you in terms of things like whether you supervise, direct or control the way in which those workers provide their services. So hopefully if you have an agency providing you self-employed workers, you're already well and truly into that process. But if you're new to it, or indeed you use agencies and they're not asking you for that sort of information, it might be worth checking in with them on a regular basis in terms of what are colloquially known as the intermediaries returns. Okay, so let's move on to the meat of the next few minutes at least, and that is what's probably become known as labour supply chain from an employment tax perspective over the last few years. It can also be referred to as employment status. It can also be looked at as being off payroll or even IR35. It's all the same sort of thing, but the bits that I've just mentioned are elements of it rather than the whole bit. Why is it an issue? Why are we talking about it today? It's because HMRC in particular are becoming far more involved in carrying out compliance reviews. If you're a larger organisation, you probably are in the business risk review process or have been recently, at which point labour supply chain off payroll working will have formed quite a bit of that, I would expect. But certainly there's loads of other reasons why they get involved, not least from a national minimum wage perspective. And so if you are having any workers where you are not their employer, or for whatever reason you are not deducting pay as you earn and NIC at source because they're self-employed, they're independent workers, they're gig workers, umbrellas, etc. All of that, HMRC are now becoming far more challenging around the processes that you have in place. Add to that, we've also got the fact that these are becoming far more newsworthy in the media. Unions are taking particular stances around organisations that have lots of off-payroll workers, particularly in the gig economy, etc. And what we don't know yet is obviously what's going to be happening from a political perspective in respect of next election dates. But the Labour Party, for one, have recently said, in fact, on numerous occasions over the last few years, have said that they will look very much more closely at simplifying employment status to do away with what they believe to be quite a large amount of false self-employment. So the reason for mentioning it is it used to be just a tax and national insurance issue. Now it's more down to reputational and even commercial. So we're certainly seeing when we're entering into contract with new clients, them wanting to know a lot more about what we've done to carry out due diligence on our labour supply chain to make sure that even though the liability might be ours if we didn't get it right, the reputational damage doesn't spread further up the supply chain to them if we do something either unknown to them or indeed they're aware of it but we haven't been compliant. So if you are wherever you are in the labour supply chain, either as a user or a provider of workers, then that's got to be something that is more definitely I think you should be paying close attention to and carrying out regular due diligence on. Okay, so let's have a look at the next slide, try and bring it to life a little bit. In my experience, when HMRC asks questions, they can ask what look like relatively innocent questions, and sometimes they can be very difficult for engagers to answer. So this is a slide where it's split into three categories, and it's largely based on the questions that HMRC will ask. There'll be lots more detailed questions and lots more secondary and tertiary level of questions, but this is the high level view, and it's split into, they're trying to understand if you have people who are not your employees for whatever reason, what do you do to, one, discover who they are and record who they are and where they are and how you pay them and what contracts you have in place, etc. If you are responsible for carrying out employment status tests for those workers, what have you done to determine that status correctly, and would HMRC, for example, agree with that? And then last but not least is, if challenged by HMRC, how do you come across, I suppose, for want of a better phrase, as being in control of the whole process. So very quickly, just covering on some of these, is it's the first stage, and it's often the most difficult one for many organisations to come to grips with, is knowing where all their off-payroll workers are. I don't mean physically, I mean which payment system they may be in, what payment terms they're on, whether an employment status test has been carried out, who's responsible for doing that, what contracts they're on, all that sort of stuff. So I would definitely recommend that, if nothing else, you have a good process in place for making sure that you are relatively easily able to respond to an HMRC request saying, for the last year, can you please let us know a full list of all of your workers, their start date, their leave date if appropriate, the amounts you've paid them, and a brief overview of the overall work that they're doing. If you can categorise those into roles, that's great. If you can tell them that you've got an automatic process for flagging all those payments, so that line managers, procurement, whoever else it may well be, can't just do it independently without a control being in place, even better. Next is, how do you carry out status assessments? I suppose the worst answer is, I don't do that. Next worst answer is possibly, I leave it to someone else to do it, but I can't tell you how that works. So make sure that if you're the person who's going to be receiving that letter from HMRC, that you are fully aware and comfortable that you've got adequate status tests in place, and not least that you have got a process in place for regularly reviewing those. You might have done something in the lead up to the off-payroll rules coming in place in the private sector for 2021, but a lot of organisations haven't revisited it since then. My recommendation is at least annually, if not more regularly than that, if you have large numbers of contractors, etc. And then last but not least is taking the independent step back and saying, well, what have we got in place? Does it stand up to scrutiny? Does the independent person feel that we've got everything in place, and does it make sense to our people? Does it just look as though it should do? Who's responsible for dealing with HMRC, and do they know that? Do they have the authority and responsibility to pull in the details from around your business? And as I already said, when did you last review your process? If it was in the lead up to the 21 changes, then probably it's a good time now to have a look and redo those, I'm afraid. I think that's probably the message from today. Okay, next slide, please. So last but not least, just some questions. I think if you are remotely nervous about whether you've got a good grip on employment status and your labour supply chain generally, make sure you know who's in scope, carry out the regular due diligences, as I've already said. Make sure you've got one person in your organisation who has the authority and responsibility. The two biggest failings I've found over recent years is, one, whatever I ask in terms of who's in scope, it usually ends up doubling over the course of the next few days or weeks as more and more information comes to light. And secondly, it can often fall between two different stools, or indeed several stools. So procurement might have a process in place for dealing with procuring new suppliers. Payroll might be paying them, but if you've got a tax function and a legal function, are they involved? Do they know what they're supposed to be doing in terms of checking and reviewing on a regular basis? Do you have an escalation process? So you might have somebody in your finance department who's carrying out the employment status tests, but for the thornier ones, do they need to be passed through to your tax team, to your legal team, or indeed to an external provider? And not last but not least is, do you have a process where those people are kept trained? So have they been recently to any sort of training to understand what recent case law around employment status is, what the latest legislation guidance being issued by HMRC, and what's coming down the pipeline? So, for example, umbrella regulations is going to be the theme of the month, I think, at the next session in April from HMRC's perspective, because they're going to let us know what the consultation came out with. So we'll be keeping a very close eye on how that's going to affect our customer base. So it's been a very much of a whistle-stop tour through labour supply chain risk, and we've got some time for questions at the end. So at this stage, I'll hand over to Saeed. And you'll see, hopefully, sorry, Saeed, on your screen, you'll see an on top of tax employment poll, just asking you in terms of your labour supply chain review as to when you've reviewed it. And hopefully the answers will be shared, but probably if we go on to Saeed and then deal with that at the end, if that's okay.
Thank you, John. Good morning, everyone. I'm Saeed Reza. I'm a senior manager in the VAT and indirect tax team. I'll be going through a brief stop of key compliance dates in the next couple of months, around above the budget in VAT and indirect tax, and I'll be talking about a new EU directive, CSOP, which affects payment services business. So just quickly on key compliance dates. So obviously, depending on the VAT return periods your business has, you have different VAT return deadlines. So those doing February quarters or month ends, the VAT return is due on 7th of April, including any payments due. Those on payment on accounts and February returns, they'll need to submit and pay by 31st of March. Those on the March quarter end or month end, they will submit by 7th of May, or if they're on payment on accounts, they will submit by 30th of April, so 7 days earlier. Obviously, businesses on payment accounts will make monthly payments to HMRC regardless anyway. There's also a few other indirect tax compliance deadlines as well, sort of quarterly reportings. So CSOP I will cover later on in this session. EU carbon border adjustment mechanism and plastic packaging tax returns also due end of April for Q1 2024, if you fall into that scheme. Next slide, please. A quick roundup of the budget in VAT and indirect tax. So a key headline: VAT registration threshold has gone up from 85,000 a year to 90,000 pounds per year. Deregistration threshold has also gone up from 83,000 per year to 88,000 pounds per year. So if your taxable activities fall below that figure and you wish to deregister, then you can do so. DIY house builder scheme. So this is a scheme whereby individuals can recover VAT in constructing a house rather than buying a house. The budget provides new powers for HMRC to request evidence, for example, invoices, etc. In the private hire vehicle sector, this is following the High Court decision in Uber, where they considered the private hire vehicle operators, taxi operators, they provide vehicles for hire, or taxis, as principal rather than as agent. This could have VAT implications on this. So HMRC have, arranged a consultation in April to sort of explore avenues to address any VAT implications in the sector. VAT-free shopping for tourists. Unfortunately, this has not been reintroduced yet in this budget, but this is still under review. Other things like fuel and alcohol duties, still frozen until 2025. In 2025, we'll see passenger duty increase for sort of the premium or fancy seats, but not for economy seats. And looking to introduce vacant fluids duty in 2026. We have more insight and analysis on the VAT and indirect taxes changes in the budget in our link. Next slide, please. So I'll be talking about CSOP. So this is cross-border electronic service payment. So this is a recent EU directive that requires payment service providers, PSPs, to report payment transactions, where the transactions that are required to report it is if the person paying is located in the EU and they paid to the counterparty based in a second country. They could be in another EU country or in a country outside the EU. The reason the EU has brought this directive in is one of the mechanisms to combat VAT fraud, particularly on cross-border transactions. So looking at, things like marketplaces, sellers may not properly register for VAT in where they sell things. So it's designed to capture these sorts of transactions, and I'll sort of come on to later in terms of wider implications and what businesses should be doing. Now, the requirement to report is on payment service providers. So it will capture transactions from 1st of January 2024. First return for quarterly returns, first return is due for quarter end 31st of March, due by 30th of April 2024. So these should be filed to the relevant tax authorities in the EU. Next slide, please. So I will soon talk about what businesses should be thinking about, but right now I will just quickly go through the implications on payment service providers, because they're the ones that are required to report the transactions and file returns. So types of businesses that may be caught or required to report, obviously banks and other credit institutions, so those are facilitate payments, e-money institutions, so those that offer e-wallets and the like, certainly like fintech companies could be caught under the CSOP if they facilitate certain payment transactions. Post office jar institutions, payment institutions, also intermediaries or marketplaces, particularly where they collect money from customers and remit them to the suppliers. They could be caught by CSOP reporting requirements. So because an EU scheme, it's businesses that have a license to operate in the EU would be caught. So for example, you can have a UK business, but if they've got a branch in the EU or a subsidiary in the EU and they provide payment services in the EU, then this could be relevant to them. Payment service providers who are caught by CSOP are required to register in the relevant EU member state and file quarterly CSOP returns to that tax authority. Now, unfortunately, as it stands now, there's no one-stop shop available where you can just register in one country and submit all your payment transaction data in one go. So businesses will need to identify which member states they'll need to register and file their CSOP returns in. As part of the submission, the EU requirements, the EU requires certain transaction data to be filed with the relevant tax authorities. Some member states may have slight variations in the rules, so it's worth PSPs that may be affected, seeking advice from different individual member states on this. Not all transactions are subject to reporting requirements, but the rules regarding who reports what and what types of transactions, it is not straightforward thing to identify. So, if for those that think they may be impacted, it's worth seeking advice on this. In terms of penalties, there's no EU requirement. There's no EU law on penalties, but different member states may have implemented different rates of penalties, and it can vary depending on the country. It's worth mentioning that some entities are still trying to get to grips with, some tax authorities are trying to get to grips with CSOP and sort of trying to ensure that businesses are able to file their returns on time. Next slide, please. Sorry, I just thought I'd mention there may be a poll running on CSOP and business, particularly PSPs that may be impacted, feel free to fill out the poll. If you're unsure whether you need, feel free to, and you need to seek advice, then please do let us know. Now, I just want to talk about the sort of wider impact on sort of the economy as a whole in terms of CSOPs. Obviously, it's a reporting requirement on payment service providers, but businesses that sell into the EU market, they will need to think about whether it is is it complying properly with local EU rules. For example, sellers that are not registered in the EU, and if they're selling goods or services to the EU, it could be distant selling, could be electronically supplied services, etc. Have they sought advice on whether they need to register for VAT? If not, it may be worth reviewing that position. Even businesses that are VAT registered in the local EU countries, are all the right transactions being recorded in that country's VAT return? Again, it may be worth revisiting this position and undertaking a review. What about your systems? Are they capturing the right transactions? For example, when a PSP reports payment transactions, is that payment also, will that mirror with what you're submitting in your VAT returns? Again, maybe worth undertaking a systems review to make sure that all the right transactions are properly being recorded. What about businesses that buy in services from the EU? They would pay money to the supplier based in another country. And these services could be subject to reverse charge, because reverse charges, VAT yourself account for services you buy from an overseas, a foreign jurisdiction. And if it would have been taxable in the country of receipt, then you'd apply a reverse charge. So this may be a cost for partly exempt businesses or exempt businesses. If a business is not registered for VAT in that country because they do exempt activities, if it's incurring costs from overseas, it may wish to review whether it is required to register under reverse charge. And businesses that are registered, are they correctly accounting for reverse charge? So that's another avenue where tax authorities could look at. So essentially, businesses that deal with buying and selling in the EU, it's worth undertaking a review of your arrangements. Are you VAT registered in the right places? Are you accounting for VAT in the right places? Are the systems picking up the right transactions? So I think that's sort of a high-level snapshot of CSOP. The rules are a lot more complicated, and we're happy to advise further for those that may be impacted. So I think it's over to the Q&A now, is it?
Great, thanks, Saeed. Appreciate it. Yes, just before we go into the Q&A, I think we're just going to share the results of the polls. Francesca, do you want to pick that up? Great, thank you. So the employment tax poll: when did you last undertake a full review of your labour supply chain? Looks like a decent number have done it within the last 12 months, which is great, and more than half within the last 3 years. So that's really positive. So interesting results there. Next poll, Francesca. Oh. So that's the labour supply chain. I think there was the indirect one as well. Should we come back to that? Just while we're doing this, if anyone's got any questions, please do pop them into the Q&A as well. That would be great. So hopefully you can see the results of that employment tax poll there. Just going to shut that down. I think we might be having a technical issue with getting the other one up. I'm not sure what's happening there, but we can share that when we share the slides afterwards. So just in terms of questions, we have had a couple in. We've got a question from Simon. If we have a contractor who changes status mid-year from clearly outside IR35 to should be inside IR35, oh, I've lost the question. Going well. Then when do you have to do that change for? John, do you want to pick that up?
Yeah, certainly will do. Thanks, Carol. So if there's been a clear change in the way in which the worker has carried out his or her duties, so is it what's often referred to as clear blue water, then you apply the new IR35 process from that time. So yeah, you might have exerted more control over that, how that worker carries out their duties, or made it so that they're paid an hourly rate, or required to not be able to provide a substitute, all sorts of bigger issues. In which case, if it's clear, then you can just apply the new treatment from that time. But it carries a huge health warning, because HMRC will assume if you've got the same worker working for the same organisation continuously throughout two different types of working, that the previous tax ruling might not necessarily have been the correct one for their purposes anyway. So make sure that you've got absolutely a clear auditable difference between what they used to do when they were outside of IR35 and what they now do now they're inside of IR35. Many organisations have helped have that clean break by effectively bringing to an end the old contract and entering into new terms and conditions with them for the new way of working. So it's not guaranteed to be absolutely 100% successful, but it will give a much more defined line as to when the change made. So hopefully will be much more acceptable to HMRC or indeed anybody else looking at it. So hopefully that answers the question.
Great, thanks, John. Got a couple of questions just on R&D. So Jack, I'm going to bring you in here. The first one is, do you have a feeling how long SME R&D claims are taking HMRC to process? Which I know we have had some guidance from them. They're aiming to process, I think, 85% of claims in 40 days, but depends very much on size, is my understanding.
Yeah, that's my understanding as well. So that's the claims, but obviously I think from the inquiry side, if they are open inquiry into that, then obviously to get processed is going to take a long time. And I know you're not going to like this answer, but if there's an inquiry opened and how long it's going to take to process that and conclude that, it's more or less how long's a piece of string. It could take, it depends on the amount of information they want, how detailed the claim was. And so that's the difficulty we're finding in that now. The amount of information our HMRC are requesting, it's proving difficult to reduce the time the inquiry length is taking.
Yeah, it's tricky, isn't that? And they're supposed to open an inquiry if they don't pay out within 60 days, I think, aren't they? But again, that's taking a bit longer, leaving a little bit of uncertainty. And if you get to almost that stalemate that you were talking about, Jack, in your piece, are you having much success, say, dealing with inquiries with the ADR, for example?
Yes, I think that's the one aspect I think has been quite successful, because, as I said, the ADR process, the whole internal memo is, once it's accepted into ADR, they have to try and close it within 120 days. And so at the end of that, you get into a room and you meet HMRC on video. But what we find is that it cuts to the chase of the issue. So we get to talk to HMRC about what they want. There's no going through information. It's actually talking about the issue and trying to resolve it face to face on one day. So I think we've seen quite a few now. I mean, I've personally involved in 5 in the last 2 years, and they've all been very beneficial for the taxpayer.
Great. No, that's good to know. Right, Saeed, one for you, I think. Does CSOP, and I still can't get share plan CSOP out of my head when I say that, but does CSOP, from your perspective, apply to the UK?
Thanks, Carol. So at the moment, there's no UK law requiring UK payment service providers to report to UK tax authorities. But with tax avoidance, tax evasion being a hot topic, and obviously elections coming up, who knows what will happen in the future. That being said, businesses or UK businesses that do operate in the EU, if they're licensed to provide payment services in the EU, may wish to review their payment transactions, and whether they might be caught under the EU rules. So I hope that answers the question.
Yeah, great, thank you. John, you're proving popular in the questions. Got another one for you. So any news or information on what HMRC are asking about umbrella companies?
So at the moment, I think it's probably a little bit of watch and wait until see what comes out next month in respect of umbrella regulation. I'm not expecting the full answer to come out, if I'm being perfectly honest, but it will give an indication as to direction of travel, if I can use that horrible phrase. At the minute, what often is the case is a typical model will be an end user will engage an umbrella worker via an agency. So what will happen is HMRC will come to the end engager, will ask for all of the details and the contracts of all of the agencies that they use, and then they will go to the agencies and ask for all of the details of the umbrellas and the standard contracts and the pay slips and anything else that they need. So they end up then at the umbrellas, unless it takes an inordinate amount of time before they end up getting to the umbrellas where they don't feel that they are compliant. And as a result of that, probably 90% are fine, whatever percentage are not so fine, but it takes them a long time to get to that. So as an end engager, probably you're only, unless you hire the workers through an umbrella and your engagement is direct with the umbrella. In other words, you don't have an agency involved in the supply chain, which is unusual, but it is happening more and more nowadays. But unless you do that, then really all you're being asked for is to open up your books for the contracts and the payments and which agencies you use. And then the agency will get the next letter landing on their doorstep with all of the difficult questions. Doesn't necessarily make you that popular, I'm afraid, when that happens, but at least it means you're not having to ask those difficult questions, answer those difficult questions.
Great, thank you. I'm conscious of time, and there are a few questions we haven't got to. We will try and share as much information with the site as we can. And please do reach out separately if you've got a burning question that we haven't had the chance to get to. So just one final slide, just to highlight the upcoming events that we've got. If you happen to be in Manchester on the 26th of March, there's a tax and industry forum in the morning. That's a breakfast in-person roundtable event where we discuss the latest tax issues and help people who work in tax and industry to network and share experiences. There's a couple of tax automation and innovation webinars coming up. These are the latest in an ongoing series, and they're providing bite-sized updates on hot topics in the tax A&I space. So please do register for those if that would be helpful. 23rd of April, there's an R&D Disputes webinar, which is a joint webinar between our R&D and tax dispute resolution teams, where they're going to do a deep dive into changes on the R&D tax credits regime and where most people are actually slipping up. So I'd encourage you to join that if you're making claims. And then the next one of these programs is on the 25th of April. So please do sign up. On that note, really great to see so many of you here. I hope you found it helpful, and hope to see you again next month. Have a good rest of your day. Thank you.